Hello and welcome to today's Forex trading tutorial sponsored by forexexaminer.com. Many beginners are online searching for three particular words: Forex predictive software. Beginners are interested in finding software that can predict the future price movements of the Forex currency pairs. Heck, of course, everybody's interested in knowing what the future price is going to be. The term predict is overused, and maybe the term should be more anticipatory, if that's even a word. But more, the markets are moving, and traders are trying to anticipate where the market might go. Predictive makes it sound like predictions make it sound much too accurate, and it's not necessary for it to be that way in order for it to be profitable. So let me reverse a little bit of that babble and let's jump right in here. Here, this again, simple moving average, same system as shown in Forex Simple Systems, and we'll get back to, in fact, to that particular trade here. Short here, still short all the way down, okay? And it's not so much that this moving average is predicting this, but this close below here is anticipating further downside movement. You could say it's predicting it, but it's anticipating it. And in this particular case, things were right on the money, and the market continued down. Now, for something that may seem more predictive, we'll move over here. And here's where we are in the trade, by the way. We're up, and we are to the good here just a bit. Now, here's something that's interesting. This is a set of lines which are outlining a percentage retracement, Fibonacci retracements, from this particular point to this particular point. And here's 23.6%. So up at this particular line, traders are looking for some type of stall or consolidation, which they got. 38.2%, market moving here. 50%, 61.8, and the other Fibonacci's. And traders may look for a type of stall in this area. So you may say, well, either of these could be predictive types of lines, but there is an anticipation that the market may move in that direction. It may very well go straight back down here too, but there is an anticipation that the market will move up towards and perhaps pause at these particular numbers, which will serve as some sort of resistance initially, and then if it breaks above it, as it has above here, may serve as a support for the next move up. This, again, in reality is anticipatory. Remember that word and look that up so you can come back and say, hey, the guy that was doing that video tutorial made up his own word. But you understand what I mean. We're talking about anticipating here. It's much like, in trading, it's much like in fishing. You know that the market's going to move in one direction. You can say, hey, look, there's a greater probability that it's going to go in this direction than the other based upon some patterns or some things I've studied in the past. So basically you're saying you're casting your net out there in hopes to catch the market as it goes through and have it continue in the direction of the trade that you have just placed. And here, naturally, it would be great for everyone who's long for the market to continue upward in the US dollar, euro dollar, US dollar, and to go all the way back up to this particular Fibonacci retracement of 100%, which would be a very nice move indeed. So that's basically it. Just outlining some of the differences between what people call Forex predictive software and actually anticipating future market moves in order to profit. Thank you very much. And again, this tutorial has been courtesy of forexexaminer.com.